Wednesday the 20th of September. Just getting the briefing underway, and firstly just recapping a couple of things from yesterday. Kind of three notable events, I guess, really to just quickly cover to summarize the main market events. Obviously we had Trump giving his kind of inaugural UN Assembly address, where really didn't cause much movement in the market. He spoke for, I think it was 41 minutes, using or coining phrases such as the Rocket Man is on a suicide mission for himself and his regime, and if it comes down to defending itself or its allies, we will, i.e. the US, totally destroy North Korea, was the exact quote phrase that Trump said. And obviously that was probably the most eyebrow-raising moment of his speech. Obviously this is upping the ante, obviously talk on a military level, certainly against what Rex Tillerson has been trying to pursue, which is a much more diplomatic process to deal with this ongoing issue on the Korean Peninsula. But as I said, reaction in the market was fairly tame, if any, really at all. But looking at the charts this morning, gold's a little elevated. We have had a brief move above R1 this morning. You can see here in the top right the charts, we're up about $5. We've had a slight pullback. A few people saying this is kind of Asia's interpretation of potentially some of the details from that speech from Trump yesterday. But US equity markets remain resilient as ever. Actually, let me just bring up, there was a really interesting stat that I saw yesterday, but net pretty marginal moves in the US equity market, but we continue to sit up at around record territory. If you bear with me 1 second, let me find a stat that I saw last night. The S&P 500 has had 35 new all-time highs in 2017. That's nearly double the 18 from last year. And the most ever is 77 record highs. We had that back in actually 1995. But all-time highs, again, that's 35 now for the year. So we've already doubled what we saw in 2016. And whether or not that streak can continue, well, potentially this evening's FOMC announcement could well dictate whether or not this trend is going to get disrupted, at least in the short term. The other big events from yesterday, just having a quick review of crude oil. Obviously crude has seen a decent move over recent weeks, and we've managed to reclaim that $50 handle, of which is kind of where we're sitting at the moment, just above the figure. But you can see here the R1 on the intraday pivot levels, a pretty good level to keep an eye on should we test at any point the upside. That being now the kind of triple top that we've tested, 50.82, which is pretty much bang on the R1 today. So that being the high on the 14th, 18th and yesterday's session. Certainly with the release of the oil inventory data, could well be enough to shake up that market and have a look at those levels on the upside. Reasoning for some of the upward move that we saw through the early part of the session. Obviously there was a few noises from Iraq in particular, and Iraq of importance because it's one of the top 3 largest producing nations within the OPEC group. And although they were saying they don't really see a need to do anything at this point, they did say if there was a consensus within OPEC to do more, what they were talking about was potentially a 6-9 month type extension to the existing production cut, then they would go ahead and back it themselves as well if it was a group consensus. So it did see some upside, but again we ran into some resistance at that previous day's high and last week's high as well, before pulling back, and now we sit pretty much in the midpoint. Just having a look, circling here where the oil inventory numbers came out last night, just while we're on the oil chart here. You can see we had a slight uptick in WTI crude. Nothing massive comparative to what we have seen in recent weeks. Markets still trying to pick through the noise of the weather impacted inventory data. So this is what we had last night. We had the API figures. The crude number was a build of 1.43 million. So it was a build. However, the build was quite a bit smaller than market expectations. So i.e. more bullish. And in particular gasoline, which we know we've been watching closely in the aftermath of Harvey and Irma. Gasoline had a draw of 5 million. Expectations were for a draw of just 2. So on the balance, a smaller build than expected in Cushing as well meant that the market moved higher on these data points. And as usual, we'll be looking for the Department of Energy to release their version of the same data later on this afternoon at regular time of 3:30. So definitely when that comes around, obviously in the interim period we'll be watching oil, but that upside level of 50.82 could be interesting if we were to break that for then maybe another push on the upside. One other risk factor to be aware of if you're trading crude today is the commencement of a technical meeting of OPEC members. This is kind of their interim meetings that they host outside of their regular 6-month official meetings. This is more to do with their to make sure that they're adhering to the current quotas that are being put in place, and they have various discussions. But the fact that all countries will be gathering to even have these discussions in the first place means then that inherently there is more of a risk of potential comments hitting the news wires throughout the day. As per usual with the technical meetings, there is no set schedule in terms of timings, but I would just be vigilant throughout the day. I think that meeting, I believe, is going on until the end of the week. So there is a bit of a headline risk towards oil commentary, but if you were to listen to the likes of Iraq, the likes of Saudi Arabia and Russia in the last 2 weeks or so, then certainly they've been more akin to talking up the market, if anything. So I'd say there's upside risks to headline noise in that respect. The final thing that we had was, just looking at the euro, we had some ECB source comments yesterday, which did obviously see some impact in the euro currency. But this is what I found was a little bit strange about those ECB source comments. It's just, why bother? Almost, I feel the sources are becoming more and more redundant because of the frequency that the ECB are using that method of communication. Looking at the euro this morning, all of that move and more has been taken back, and here we are trading up, having tested overnight the R1 already, pushing on to 121. So if the ECB's objective was to weaken the euro, well then they failed miserably with that source report. And the way that the market, of course, as you know, tends to react is if you keep utilizing commentary again and again and again, the return from your investment of that communication strategy diminishes over time, the more often that you use it. So it's going to be interesting. One thing I would say is that if the Fed, and we're going to talk about the Fed more in a couple of minutes, but if the Fed come out and the overall interpretation post this evening's event is a dovish one and the dollar weakens, then the ECB, you're going to have to expect probably more ECB source comments, more ECB speakers to see out the rest of the week. Because if that happens in the backdrop of a generally positive economic environment in Europe, almost recent piece of data, German ZEW yesterday, bouncing back after the prior month's weakness. This is all kind of indicative of the euro-dollar pair having an upside bias going forward if the Fed are deemed to be dovish this evening. And so the ECB's got its work cut out, so to speak, in that scenario. But obviously it's dependent on the Fed this evening. Okay, a couple of things then to talk about from a news perspective. And I'm going to kick things off with the pound. So let's just have a look at the chart and where we stand at the moment. You can see pivot providing a degree of short-term support here that we've seen since the overnight session, the Asia-Pac session commenced. You can see though here in the pound, pretty seesaw day yesterday. Some reports of Boris Johnson It's kind of getting more likely that he's going to resign. We had a little bit of movement in the pound. I guess some of it might have been the case of if initial weakness on the back of that headline. If he is removed, then it means that there's less disruption within the kind of senior cabinet of the Conservatives, so they can go on and push ahead with their negotiation process of talking to Europe about Brexit terms. However, the latest news that we have had, and this does involve Boris, is the front page of the FT last night. I'm not sure if you caught that, but it's kind of splashed everywhere this morning. This is talking about Theresa May preparing €20 billion EU budget offer. So this is the latest that we've had. So in a nutshell, Germany's Angela Merkel has been told by the British government to expect Theresa May this week to offer to fill a post-Brexit EU budget hole of about 20 billion. The first attempt by London to meet European demands to settle its divorce bill. If you remember, this has been a very contentious issue because there's been the different schools of thought. Those on the European side who have said as much as, well, Britain, you owe us 100 billion euros in order to pay for things like EU budgeting, which has been planned forward many years in advance, and this is your contribution that's been factored in, so therefore you need to pay and respect these fees in order to break away from Europe. Then there's been David Davis at the very beginning, this was probably 3 months ago, who said, how about 1 billion? Or how about nothing at all? Which is kind of along the route that Boris has kind of sided more along the lines with, which has obviously flown in contrast to that of May. So what's happened here? Let me just outline a couple of details from this FT article, probably give you a bit of better context. The EU's opening position had claimed the UK had liabilities of up to 100 billion, which would net out at 60 billion when British receipts are stripped out. A 20 billion net offer would allow the EU to avoid reopening its long-term budget plan prematurely and would cover unpaid projects Britain signed off before its 2019 exit. It would not, however, cover long-term liabilities or spending promises made during the transition period. So I think the thing to take away from this, actually, when I first saw the headline last night, I thought this was quite a positive. Now, don't get me wrong, Europe are not by anywhere or any means going to settle for 20 billion, but this is the first time after a 3-month stalemate where we've had zero progression almost through 3 individual phases of discussions between the negotiation teams. This is the first time there's been some headway, i.e. Britain have put a reasonable number out there, and this is just the art of negotiation. Obviously they go in with a more realistic number rather than 0 to get the ball rolling, to then engage with Europe, and then now the discussion comes and the kind of what each country wants on either end of the scale starts to converge with one another over time, and obviously that time is limited, as we know, given the triggering of Article 50. So this to be monitored, and obviously this comes at a very key point. You know, this type of headline has come out specifically today because of timing. Why do you think that this type of headline has come out today? It's because Theresa May, of course, is giving her keynote speech in Florence, of all places, on Friday. And so this is almost kind of drip feeding in the detail to the market about what to expect, and if anything, you'd probably take this as more of a net positive, that this should then at least bring Europe to the table to want to recommence discussions, because Juncker and May are meeting, I believe, next Tuesday. So she's kind of laying the ground, I'm sure, to provide a little bit more clarity, but doing it also in a geographic location that I'm sure would be more European friendly in her delivery, as well as this latest number. The one thing this has meant is we've had an update on Boris. So the Foreign Secretary has backed away from his threat now to quit the government over Theresa May's Brexit strategy. So within the period of him releasing his document at the weekend, for them him saying I'm going to resign, and now him saying I'm not going to resign, just putting it out there. One idea that I was just discussing with peers this morning was that I find it very difficult to actually believe that Boris Johnson is a buffoon, that some people often use the term associated with him. I think he is an incredibly intelligent chap, and I think he does know actually what he's doing. And not to get too conspiracy theory, but I think a way of managing this situation, and when I talk about managing it, I mean it from a Conservative Party point of view, would be maybe Theresa May knows that it's inevitable that a divorce bill will need to be paid in order to secure a transitional deal. She is also aware of the inevitability that this likely means that she'll fail to deliver a hard Brexit, which was quite unlikely in the first place. So you're getting a more softer Brexit. Now, if you think about the type of people that were backing the calls for this then is going to distance her and her leadership and party from this kind of the whole idea of why her election mandate in the summer which was to deliver what the people of Britain had decided in the summer of 2016. So how do you counteract that? How do you keep the public on board with you? Well, how about you use someone like Boris Johnson as a bit of a play to he maintains a hard Brexit angle as a senior Conservative cabinet member on the front bench, and then everyone kind of backs his view, but he remains part of the team. And so in essence, you're kind of satisfying both sides. You're getting the deal done through May and progression on the European side, but you're keeping those more kind of anti-EU sentiment that was apparent from the referendum last year satisfied. And so maybe this isn't what it might appear on the surface. Maybe there's something a little bit more coordinated going on here. But obviously this is all just pie in the sky thinking. But the fact that these types of things are happening, I think it just seems all a bit too coincidental, timings wise, with what's coming up in coming days. Anyhow, looking at the pound this morning, as I say, it's pretty quiet. It's been fairly range bound this morning. We do have some economic data of some significance coming out later today. That being 9:30, you've got UK retail sales for the month of August. Now, this obviously is up there as an important measurement for the UK at the moment, given our dependency in terms of economic output, its contribution from the retail sector or service sector. August should be interesting. I guess you've got to factor in as well, August does tend to have a bit of a seasonal effect, you would imagine, in regards to tourist numbers going up, the general summer holiday season, so hotel prices, the costs of restaurants, things like that would be probably more busy. And so it'd be interesting to see what the breakdown of these numbers are and whether or not we can read through any of that seasonality to see what the actual performance is. This obviously comes in the context of a struggling consumer. As we know, saving rates, record lows, the pinch of a fairly benign improvement in wages comparative to resurgent inflation is a pretty negative cocktail for the consumer sentiment and its ability then for people to spend. So this could be quite an interesting number. That's kind of your main event for sterling today. And certainly that number, if it was outlying enough, could well bring into play a retest of R1. 135.87 looks a pretty interesting level. That marking the high that we printed when Europe stepped into the market yesterday. On the flip side, probably just playing the same range from yesterday, which is pretty much defined then by R1 and S1 either side. Bearing in mind that on the lower level, you've also got 135.05, which was pretty much to the tick yesterday's low, is that S1 level, as well as the 135 psychological handle as well, which has been a fairly big level over the last few months. Okay, wrapping up some of the other headlines. If you were looking at the Aussie currency on your chart, DA6, you might have recognized that there was a bit of a pop in the Aussie overnight to the upside. Now, this was chiefly led by its peer, the Kiwi. The New Zealand dollar hit a 6-week high. Why did that happen? Well, basically, this is a graph of the New Zealand dollar appreciating. It jumped on the back of a new poll showing the governing National Party could rule alone after the country's general election. If you didn't know that was the case, there's a general election happening this weekend in New Zealand. And the poll has the National Centre-Right Party, which has governed pretty much for the last decade, up 6 percentage points at 46%. The main opposition party, Labour, is down 7 percentage points. So what could have been a very close run race has now opened up into a much more substantial lead for the ruling party that's been in place, and the market typically tends to like continuity in that respect. So if you're looking at the Aussie, I wouldn't imagine though that there's enough here to keep the Aussie up at these levels, i.e. hence we've had a bit of a pullback, because this is more of a move in the Aussie on the back of the Kiwi move. And so if you're looking at Australian dollar already, it's already paired probably 50% of the move that was seen in sympathy with the move in the New Zealand dollar last night. Okay, quick talk then about the Fed. Now, I'm going to try and whip through this as quickly as I can, because obviously we're going to talk about this in length later on in the session. But there's a couple of graphics here that I want to show you. We'll talk about this, as I say, much later on today, and I'll send out some research reports to you this evening so you do have them to hand. Now, one of the key things that we're looking out for, first of all, from the Fed today, is this decision in regards to the tightening of the balance sheet. So this chart I'm showing you, let me just give you a bit of an explanation here. So this is how the Fed plans to reduce its holdings of securities, and at the moment the Federal Reserve reinvests the payment it receives on portfolio government bonds and MBS, mortgage-backed securities, it amassed during the crisis, keeping its holdings steady. So basically they've been reinvesting those payments from those bonds. When the balance sheet actually starts to get wound down, which is what we're expecting, most consensus is this will be announced today and then it will commence from October, the Fed will then start gradually phasing out these reinvestments. This then a form of subtly tightening policy in essence. How does this work, and how do we make sense of some of these charts that we're looking at here? Well, this involves setting a steadily increasing set of caps. Payments will only be reinvested to the extent that they exceed the caps. The caps will initially be set at $6 billion per month for treasuries and $4 billion for agency mortgage-backed securities. They'll then be steadily lifted in 3-month intervals until they peak at $30 billion for treasuries and $20 billion from MBS in about a year's time. So this is that staggered approach. You can see on every 3-month interval until we hit that upper ceiling of then the amount that is in effect being reinvested. So reducing the amount that currently would have happened. So that's the kind of first key point we're looking at, but there is an unknown quantity here. There are unanswered questions. For instance, the size the FOMC is ultimately seeking to cut the balance sheet to. At the moment, it's currently $4.5 trillion. Pre-crisis levels, well, who can tell me what was the size of the balance sheet pre-financial crisis? Anyone want to give me an estimate in the chat room? Keeping in mind the current Fed balance sheet is $4.5 trillion. What was it pre-financial crisis? Yeah, okay, so Darren, Piers, 800 billion. That was the figure. I think, Faris, you need to do some of your economics research. You've gone the opposite direction. So remember, by doing QE, they're making the balance sheet bigger. Whereas pre-QE, obviously the balance sheet size was much smaller. Okay, so moving on then, a couple of other things to be aware of. Aside from the balance sheet, arguably the balance sheet tightening has kind of been priced in to some extent. If you ask, okay, so what I've just covered in regards to this staggered approach, the caps, the value for treasuries and mortgage-backed securities, you might say, well, that's an awful lot of detail. Where did that come from? That came from the Fed. They said all this detail back in June. This is part of their communication strategy of letting the market acclimatize to the fact that this event is coming. They already begun that process in June. We are now in September. You can see how they plan these things in as to not shock the market, so the market can start to reprice itself in a gradual and controlled manner. The thing though that might cause actually the bigger market move today is when we actually start looking at the FOMC and their expectations of the rate trajectory going forward. If you remember the so-called dot plots, they don't just measure 2017 interest rate expectations by year end, they also measure 2018, 2019 and the longer run. And it will be this trajectory of interest rate hikes and to what level that could well determine the overall movement that we see in the market later on this evening. I would say on the balance, the risk is that that rate hike path gets made more shallow, i.e. more dovish. They don't increase interest rates as aggressively as they had planned previously for next year and thereafter. If that does occur, this would be what could be in for is the Fed giving the hint that yes, we will hike interest rates in December and we will have executed the 3 that we told you that we were going to do back in December of 2016. However, going forward, it's going to be that slow, gradual cycle thereafter. If you think about the hikes that we have received from the Fed this year, they've pretty much followed the same strategy each time. They've managed to talk up the prospect of an interest rate hike to the point where the market has fully priced that in, and then they deliver what is usually a dovish forward-looking outlook, which means that they execute a dovish hike. And I would say this is the risk, once again, that similar type scenario we've got this evening. Likelihood is market pricing. If I think about non-farm payrolls that we had, how long ago was that now? 3 weeks ago? It was right at the beginning of the month. I think I remember it's the 1st of Sep. That figure saw the chances, so immediately after that figure, the chances of a December rate hike fell to about 30%. This morning, or as of yesterday, they were up in excess of 55%. So the hike is now priced in. So you've seen a pretty strong change in market sentiment because the Fed have continued to stay the course. But tonight will be obviously interesting in that respect. The other thing we're looking out for is this, and I'll send you out this document later, but this is the actual projections then for the June summary of economic projections, and this will be the latest one that we'll get this evening. Remember, this evening is one of the unique 4 times throughout the year where we have the statement, the SEP, the projections, and then also the press conference with Janet Yellen. So we're in for the long haul this evening. The main one that we're looking out for here is the inflation in particular, because as we well know, if I flick over to here, this is inflation stalling. Headline inflation in the white line, the orange line, core consumer price expenditure inflation, which has been tracking down at 1.4%. Core CPI in the US year on year at 1.7 certainly has remained, I think, for 3 months now, 0.3 below its target level. How confident can the Fed be going forward that the tightening labour force will ultimately create more demand and increase inflationary pressures to move this back up to target is the question. As you can see here, the analyst consensus is that for the core PC inflation, the consensus is that we're going to get a downgrade across all 3 years, this year, 2018, 2019. So if that occurs, obviously that's probably going to result then in a more shallow interest rate trajectory going forward. And that's when you'll get your dovish reaction. Finally, this was an excellent table or infographic that the chaps at ING have put together. They're extremely good at making these more concise ways. I'd say for any of those newer to the market, this is probably a much easier way to tackle an event like the FOMC, because it defines it in some very clear sections. So you've got two things here, section 1, section 2. Section 1, the announcement and the projections. Section 2 is when we'll await Janet Yellen to start speaking. Remember, this is at 7 PM and then Yellen starts at 7:30. Now what they've done here is ING have put in their base case scenario in orange, and then they've put what could be on the right, what needs to be said, and what the projections need to be in order for this to be hawkish, and then consequently what could be said and what the numbers could be associated with the projections for it to be deemed to be dovish. So going left dovish to right hawkish. And then same case here for Janet Yellen. So let's say on balance, in terms of what's Yellen going to say, she's going to say unwind a balance sheet to help tighten financial conditions in terms of asset price valuations. If she was to say on the far hawkish extreme, easier financial conditions require higher policy rates, that's a much more aggressive stance in that instance. The same case can go for policy rate itself. No clear signal of near-term policy bias. This is what you would expect her to say. But if she was to be more outright explicit and say a rate hike seems appropriate soon or later this year, that just again means that December's a done deal as far as we can be concerned at this point. Okay, quickly then, looking at the calendar, apart from the retail sales report, it's pretty quiet overall. You've got existing home sales, all inventory numbers we talked about earlier, and then the Fed. I think the one thing to contemplate is if you're trading sterling, certainly the retail sales might provide some short-term opportunity, but the Fed's the main event today, no doubt. And so this isn't happening until 7 PM this evening, which means that a lot of investors, if you think about it, if you're a bigger player in the market, why would you come into the market and put to play any capital ahead of such a big event, which obviously, although there's a baseline expectation, does carry significant risk to holding any positions. That meaning then that if you are going to enter the market, I would say you want to be fairly realistic with your targets of what you're going to achieve between now and then, because the bigger event, even for intraday prop traders, is going to be awaiting the aftermath of the event itself to then trade accordingly later on this evening. Okay, that's it. So have a good day. Just so you're aware, I'll be here all day. So we'll have a Fed preview later. We'll be here covering the statement and the press conference with Janet Yellen. So we'll probably aim to wrap things up at about 8 PM this evening. So hopefully you can join us. Okay guys, have a good day.